Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Joe Herkin, the former CEO of Issuu, ISSUU, a content publishing platform for millions of creators out there that create printable kinds of collateral and want to publish that on the web. It's actually quite a large business that Joe and team sold last year in 2024 successfully. So this is the journey to 30 million and selling for nine figures. It's a really interesting story with some practical investors along the way and some big debt that turned out to be very practical before it was sold in 2024. We talk about all of that on the podcast, and I know you'll like this episode. I'd like to just say a few more things. I meet people who listen to the podcast all the time and meet me and say, Greg, what do you actually do? And I'll just describe that briefly for you here. I do two things with founders and practical founders who are doing it without big VC funding. I'm a one-on-one strategic advisor to several SaaS founders and their teams who are looking for strategic help and guidance, and that crazy journey between somewhere between 1 and 10 million as they're going from the crazy startup to a more scalable and valuable factory. I'm working with them several times a month. So you might call it a coach, but we're talking about the big issues that drive the biggest growth and the biggest impact on your valuation, including what do I want to do with this thing someday and what do I do this week with this one particular thing. So I love that journey. I do work one-on-one with founders. You can contact me about that. The bigger thing is the Practical Founders peer groups. I've got 35 practical CEOs and founders of B2B SaaS companies in my peer groups, four groups of 8 founders. There's a couple openings right now, and I'll probably create another group this year. We meet every month, as CEO groups do, to work on the key issues in their business, and not just to hear what Greg has to say about it, but collectively what the group thinks about the issues that face each of the CEOs every month. And it's all the stuff that you'd imagine in the journey from 1 to 10 million about teams and funding and cash and pricing and changes and what should I do with AI and how do I hire the right CFO and which metric is most important to me and how do we add a growth lever and all the other challenges that show up every week in the business and in the heads of the founders. So I really love doing both of these, working with these crazy but practical founders. And let me know. There's information about the Practical Founders peer groups on my website, practicalfounders.com. So sorry for that interlude there, but I just wanted to describe what I'm up to and what is all the insights that I gather from these interviews. How do I use them in my day-to-day life? Hey, Joe, welcome to the Practical Founders podcast.
Thank you so much. Glad to be with you, Greg.
Yeah, it's morning out there in Silicon Valley. I checked the news and the Silicon Valley news between, the latest AI, DeepSeek, and everything going on. It seems like the world is changing by the minute in Silicon Valley, less so everywhere else. Is that how you see it this week?
Well, I think actually right now, as we're talking, the world is changing all over the place.
Yes.
Faster
Okay.
than any of us expected. In Silicon Valley, clearly everybody's focused on AI, and the
Yeah.
announcement related to DeepSeek over the weekend has
Yeah.
put people in a bit of a flurry, from what I can tell. I mean, I
Yeah.
think there's a couple things. One is AI. We are in a world right now where AI is changing so fast that if you miss the headlines from one day, you're
Yeah.
behind by the next day.
Isn't that amazing?
It's amazing. I mean, we've never, we saw amazing growth and amazing transformation in the 90s with, the
Oh, yeah.
development of Netscape
Yeah.
and all stuff. But it was much slower. It happened over weeks and months and a year, a couple of years. Here we're seeing truly transformative changes day by day, week by week.
Yeah, it's really amazing. You and I have been doing this rather a long time. I did it in the 90s, I did it in the 2000s and the teens and all the different models. Tech has always moved faster than everything else, but you're right. It is crazy and exponential and
Yep.
a little unsettling out there for practical people who try to figure out what the mode is going to be in 2 years and what their
Sure.
advantage is and so forth. So we'll talk about how to play the AI game.
Yeah.
You're a practical-ish founder in Silicon Valley. You built a sizable company. You did it with some investors, but you kept them in the practical zone. You raised some debt in the practical zone. You didn't do the full VC thing with Issue,
Yep.
Issuu, the company you ran for 10, 12 years and then sold last year. So it's a really exciting story. Joe, why don't we just start with what is Issue? And then we'll talk about how big it got and what happened with the sale, and we'll go back to the journey.
Sure. Yeah. Issue is this massive digital publishing platform that enables marketers, primarily SMBs, but enterprises as well, to take all of their marketing materials, their publications, their collateral, their catalogs,
Mhm.
brochures, all that kind of content that they're often creating using Canva or Adobe or Microsoft. And then once they create it, that content gets uploaded to Issue where the content is hosted. So it's available publicly and accessible for the marketer, the creator, the business to share and distribute it anywhere they want digitally, and then transform that content into a range of assets. So you can upload
Mm.
one brochure and then Issue automatically using machine learning and some AI transforms it into the assets you need, whether it's a social post or an article or being able to share elements of that content, and then provides a whole set of data and analytics around the content. And then there's integrations with Canva, Adobe, HubSpot, various others. So it basically Issue is sort of a micro CMS, if you will. You know,
Yeah.
you create the content wherever you want to create it, and then Issue is the platform where you host it and from which you share, distribute it, and understand how people are consuming that content. And then with that data, you can then make decisions about the next set of content you're going to create. And it's used from everybody from real estate agents and restaurants to great big companies around the world and everybody in between. We
Yeah, so
have,
everybody in tech thinks that content is blog posts and web pages and social media posts and so forth. But
yeah,
if you go 1 inch out of that, there's collateral
yes,
and PDFs and guides and
yeah,
books and
yep,
menus and all of this stuff.
yeah,
If you go to issue.com, issuu.com, they talk about flip books. Drag a PDF in, it makes a flip book. So you
yep,
can, do that. Is this really all about that other collateral that we used to print,
yeah.
that
So
didn't make it into your WordPress website kind of thing?
yeah,
Or is it that simple or not really?
yeah. So now, yeah. I mean, now you can take that content that you used to print, and in some cases still do print, but
Yeah.
you're able to save on printing costs dramatically,
Mm.
and then
Oh,
you
I see.
have you can distribute it wherever you want. You know, when you're printing something, you're limited by the cost, and you're
Yeah.
limited by the form of distribution, which is either a kiosk or a mailing or whatever it happens to be. So
Yeah.
when you're printing content, that's just the beginning of costs. Then there's the actual distribution
Yeah.
and then of course there's the waste aspect of
Yeah.
printing. And so what Issue provides still is a mechanism to take that high quality, longer form content, put it into a digital format so that in fact it's totally married now with your website. You can embed it on your website. You can use pieces of it in any kind of marketing campaign that you might have. You can share it in an email. You can distribute it via social in a range of different formats. So once you have that one piece of content, you can then, it's brand approved high quality content. Now you can take a piece
Ah,
of that brochure and use it for social. So one
yeah.
of the things that would happen often is businesses will have people running social who are creating content on their own that may or may not be associated with being brand approved, right?
Yeah. Yep.
So what Issue allows is you're going to put a huge amount of effort into this brochure, this catalog,
Yeah, right.
menu, ebook, HR collateral, whatever it happens to be. And now you can reuse those pieces in a range of different campaigns or formats.
Yeah.
We had uh, around 1 million folks a year who used the product. It was a
So
freemium,
you
is a
use
premium
the
product.
content engine side of it, not just viewed the PDFs
Correct.
online, that
Yeah.
kind of Yeah.
in the range of, in the range of 100 million uniques a month who consume the content, but
Right.
the actual creator folks, about a million a year. And again, it was everybody from SMBs, solopreneurs to really big companies and publications.
Wow. And you didn't come up with this idea. We'll talk about your journey.
Yeah.
The Danish guys figured this out and got it going and got a crowd going, and you came in as the, let's say, CEO for hire or the scale CEO or something like that. But how big did the company get? What can you say about employees and revenues
Yeah. So
and
the
size
uh,
over a 10-year period? Yeah.
company company was started in Denmark. I joined in 2013 to run it, and I flipped it from a Danish company to be a U.S. company. So in fact, we were
Yeah.
an American company longer than we were Danish.
Yep.
And I ran it as CEO for 11 and a half years, and we
Wow.
had teams in Portugal, Berlin, Braga, Portugal, which is northern Portugal,
Yeah.
Berlin, and Copenhagen, and then in the U.S. So we had about 130 people in the company. We used some contractors, but about that. And at a revenue level, we got the business to just around 30 million.
Yeah. So it wasn't a lot of people on the podcast here, they get a business to 3 million, they're up, and 5 or 7 million, they're up even further, 10 million, they're starting to scale.
Yeah,
It's real money, and founders decide if they really want to be the CEO and do that first phase of scale, get to jump to 30 million,
yeah,
over 100 people, senior team,
yeah,
global scale, all of that. You got that, and you sold the company last July in
yeah,
2024. I know you had investors and, they eventually like to get paid back, whether they're VCs or, you've got them in a practical zone. But
yeah,
what can you say about the acquisition?
yeah. I mean, even in a practical zone, your investors need to
Yeah.
have an outcome and liquidity. And I think, you know, anytime you're raising money, whether even if it's just friends and family or even a loan,
Yeah.
you got to pay it back. And part of paying
Yeah.
it back is an exit or some sort of liquidity event. And there's a range of different
Yeah.
ways to define an exit. An exit can be everything from an IPO to a sale to a secondary to
Yeah.
uh, debt financing. There's a range of different ways to look at that. But the other thing I want to just say about how we ran the business is we ran what I like to call a pro-grow, profitable and growing. And
Pro grow.
from
Right.
pro-grow. So from 2016 to 2020, we ran Issue profitably. And then we ended up,
How uncool, Joe, in
how
Silicon Valley.
uncool.
Yeah.
But by the way,
Mhm.
between 2016 and 2020, profoundly uncool. People would roll their eyes like there's Herkin talking about profitability.
Yeah. They're
Uh,
taking off. Right. Uh-huh.
and we grew Issue. One of the things I'm most proud of is the the way in which we served our customers and provided real value to their business
Imagine
while
that.
also being profitable. We grew the business every single year that I was here. We grew it. We never had a down revenue year.
Well, that's really interesting, and I did the VC-funded growth game in the
Yeah,
'90s, and then again at, the early, SaaS days, and, how strange is that? Like, to, not put every dollar to grow as fast as possible, and even that thought that if you're profitable, you're scrimping on your customers, right? Or
yeah.
your employees or something like that, that it's,
So I think
yeah.
profitability. Every big tech company, frankly, every big company that we admire and respect
Yeah.
are profitable,
Yeah.
right?
Mostly,
And
yeah.
we never talk about Google's profitable. We don't talk about that aspect. And Amazon famously kind of shied away from profit, but a lot of it was managed.
Yeah.
They had choice, right? To
Yeah.
me, it's more about choice profitability than necessarily specific. Do you know how to get there, and are you making choices to invest or grow instead of getting to the profitability level, but you can. You're not sort of in this phase where you just have to keep raising money to spend money to keep growing, where
Right.
you're just constantly chasing after the next set of investment. So again, we ran Issue profitably from 2016 to 2020. Then we ran it again the final year before we sold. So we got back to profitability. So we were unique in that not only did we run it profitably the first time, but we got back. So we got to profitability twice. And I think it's important to understand how you do that. The most important aspect of profitability that I think most people don't think about that much is that if you want to truly build a legacy product and business where you are serving your customers effectively, you have to
That
be
lasts a
profitable.
long time. Yeah.
You have to be profitable
Yeah.
because in being profitable, you're committing to your customers that you're going to be around, that they are not going to have to go find some other solution. You're communicating to your team that this is a company that can be counted on.
Yeah.
So there's a lot of elements within running a profitable company that gives the success that so many people want, that they often think they're going to get just by raising money and spending it on
Right.
marketing.
Well, and we hear about the rule of 40, the trade-offs between faster growth and profits, of more profits and slower growth and
Yeah.
so forth. I don't know if you feel the trade-offs, but at least you're saying that profitability is healthy, it's sustainable, it's
And guess
uh
what? Guess what, Greg? In 2024 and now 2025, everybody wants profitability, unless you're an AI
yeah.
company, of course. But
Yeah.
in the last few years, what happened in after the pandemic is there were a number of companies, particularly tech companies, that had a really nice 2021 and
Yeah.
2022, and
Boom time. Yes.
they raised huge amounts of money on very high valuations that in many cases were not congruent with the reality of what their business was, right? And so how was that for how I put that? But
Which means they're screwed, because they raise too much
Well, they
and you
raised too
can't
much. So
yeah,
now what are
right.
they going to do,
Yeah.
right? And so now they have to go get to profitability because they're going to have a hard time raising
Yeah.
another round, given the sort of way in which they raised before and the structure of how
Yeah.
things were done. So
Yeah.
not having a profitability plan actually creates a lot of risk. I'm not saying you always have to be profitable. There's plenty of reason to grow beyond the revenue you're bringing in. If you've got a really big opportunity in front of you and you can understand where the market is going, or you think you do, or you're in a space that's incredibly competitive, but you always have to have a foundation of this is how we get to profitability. I encourage all CEOs to, as part of their plan, to be understanding how, if we have to, how do we get this thing to profitability? Because it's a different way of thinking.
Yeah, and I actually, I'm more converted. It was a more practical time, even VC funded in the '90s, and it
Yeah.
kind of went crazy. Like starting with the dot-com era, which is, profitable is a sin, and cash flow positive and so forth. It's bet it all, go for it. It's all the big money, and funds got bigger and so forth. Here at the same time, the cost of making software, is going straight down
Yeah. I
and
mean, you and I
going
have
to
been
market.
around a long time, right? There are always these trends where
Yeah,
we dismiss the importance of profitability. And then every single time, I mean, I went through the downturn of 2000. I went through the downturn of
yeah,
2008. In Q1 of 2016, there were beginning to be inklings. There was like, VCs were starting to say, watch your cash. And then we went through 2020 and that didn't actually manifest. We were
yeah,
seeing, and now I think 23, 24 with the limited amount of liquidity, we're starting to see again this emphasis on profitability. So I think it goes in waves, and I think
yeah.
it's not just it's never just one way or the other.
Yeah, that's right. It always depends, and
Yeah.
it's a choice, I guess, and it's a healthy choice.
But you want to be
Um,
in a position to have to be able to make the choice. I think that's my main point.
yeah,
I've been, since I sold Issue, I have a CEO coaching business, and one of the things that
okay,
I'm telling talking to my clients about and writing about is have a choice. You may not be profitable, but know how you're going to get there.
right.
Yeah.
Yeah, and that optionality to be able to retreat is you know it may be the thing that saves a lot of companies, right? From taking the all or nothing pill,
Yep.
that it must work and everything must line up and so forth.
Yep.
So, yeah, we definitely have seen that. So, who did you sell Issue to in 2024? Let's talk
Yeah.
briefly about that, and we'll go through the journey.
So we sold Issue to a firm called Bending Spoons, and they
Hmm.
are based in Milan, Italy, and
Yeah.
have been acquiring primarily product-led growth startups, mostly SaaS, many of them self-service kinds of businesses, although they recently also just acquired Bright Cove, which was a publicly
Yeah.
traded company that they're
They own
taking private.
Evernote,
They
the
own
old
Evernote,
bank
they own
mutual, and
Meetup,
yeah.
Remini, they bought WeTransfer. So they're a really interesting organization. They're a holding company. They
Yeah,
buy
uh-huh, yeah,
companies to hold them and run them and operate them. This is not a PE firm. They have
yeah,
their own set of employees that they have get involved in the businesses that they go acquire.
yeah,
And I found them to be a fantastic partner and buyer.
yeah,
They approached us and moved very quickly
yeah,
and put an offer on the table that was reasonable and good for
yeah.
everybody.
Yeah, and,
Yeah.
so a holding company is like, Warren Buffett at Berkshire Hathaway. They're less hands-on, but
Yeah.
they buy companies, right?
Yep.
And they
Yep.
pile them up and take the profits and buy more companies and
Mhm.
do other things with it.
Mhm.
And this is the same kind of thing. Maybe, the central Bending Spoons team, as many buy and hold, has some resources and some playbooks and some team to, help,
They have
but they're kind
playbooks,
of
they have
piling up these
engineers.
independent companies, the
Yep.
brands,
Yep.
with leaders and P&Ls and all the rest of that.
Yep. Yeah.
Yeah.
And they also they're unique in that they have an engineering team. They have a really strong team
Mm.
that can help grow and build the companies that they're buying. So they're not
Yeah.
just buying to kind of hold them and sit on them and
Yeah.
hope that things move. They're
Yeah.
putting in their own resources to grow and build it.
Yeah,
And we've
what I
seen that.
say is, if you can build up, I had Jason Fried on the podcast, from Basecamp, and, it's 20 years, and he's been very profitable all these
Yeah.
years, is very sustainable. He's building the business, so he and his employees and his customers reap the benefits, not
Yeah.
some other investor.
Yeah.
So, and you had a profitable, sustainable business. I know you had some debt in there and you had
Yep.
some investors, but, could have gone on for a long time for
Yep.
the right reasons.
For sure.
And so they're kind of continuing that line
Yeah.
with an exit point in there, right?
Yeah.
They
Yeah.
don't have an exit. They're not trying to sell it again and flip it or any of that. And,
Yeah. What's
uh,
nice about it is, that
yeah,
our customers are able to continue to get the tools and services that they've come to rely on and
right.
can keep getting access to the
Yeah,
services.
maybe someday. This used to be the thing. If you got VC funding, your customers said, "Oh, they're going to survive," right? But
Yeah.
everybody knows better. It's a very strong drug that doesn't always work out. So,
Yeah.
if you're profitable, sustainable, it'll be a long, around for a long time.
Yeah.
That's
Yeah.
great. And you came in. You weren't one of the founders. You came in as CEO. Did you get a nice chunk of that? Not the kind of CEO for hire. You had enough interest for 12 years to,
I was there, yeah, I
the
was there
enterprise.
11 and a half years. So,
Yeah.
in many respects, clearly there was a strong set of founders that created the company and the idea. I ran the company longer than the founding CEO,
Of
and in
course.
many
Yeah.
respects felt like Issuu was my baby. I mean,
Yeah. You
it's
must have.
it's
Yeah.
the longest job I've ever had. I I love the business and the product and what we do and the space
How
that
fun.
that we're in.
Yeah.
The create, Issuu is this really interesting business that was sort of sat at the intersection of creativity, technology, innovation, and catered to people's passions, right? Like, there was
Yeah.
a lot of small businesses that relied on Issuu. And so I always like, if you can be in a business where you're catering to how other people are building and creating their businesses in a way that's meaningful to their lives, that's a pretty good space to be in.
And it's a little bit one off the techno cool zone, right? Of the
Yeah.
latest and greatest of
Yeah.
video and website content and
Yeah.
a new website builder and so forth. This is traditional stuff that is monumental. I mean, you go
Yeah.
around the world and there's an infinite number of printed materials and, you know, uh, printable materials that ever get printed that
Yeah.
we want in the right kind of format. And,
Yeah, Issuu
WordPress.
didn't
Yeah.
did not only take PDFs. PDFs were a big chunk of the kinds
Yeah.
of content uploaded to Issuu. There were other formats, of course, as well. And what we found is that it's really interesting when technology evolves. We often think that the previous technology is no longer going to be used,
Yeah.
right? But it's so funny. We say that, and then we're proven wrong over and over and over and over again,
Yeah.
right?
The blank is dead myth, right? Yeah.
Yeah, not only is radio not dead, but look at how well Spotify is doing as an example, right? And I
Yeah.
think it's the same here. Like,
Yeah.
just because there are really efficient website building tools,
Yeah.
and there are a number of them, you still need to put content in there. And
Yeah.
your website is not the only way that you're interacting and engaging with people, particularly for small and medium-sized businesses, and particularly for document kinds of content
Mhm.
that matter, whether it's whether it's a brochure or a HR document or a newsletter
Mhm.
or whatever it happens to
Yeah.
be.
Awesome. Well, that's really cool. So, what a journey, and we'll
Yeah.
we'll go back to the journey here. Joe, what kind of guy are you? Are you the well, let's say the American sales-oriented CEO growth, pro grow, practical guy
Yeah.
that loves this kind of technology, or were you a coder, or well, what was your background that got you ready to step in as CEO for a company you really liked?
My background is really common. Lots of people have a similar background. I studied Chinese just like
Oh, of
everybody
course,
else.
yeah, that's like everyone does these days. We
That's
will
if you
someday. Yes,
if you
right.
want to be a tech CEO, you study Chinese. I studied Chinese and political science in college. I spent my junior year living in Beijing and traveling all over China,
Okay.
and then spent the 90s living in Hong Kong and Beijing, and for a good chunk of that ran the business side of things for the EIU in Hong Kong and in
Mm,
China for their China business. So they had
mhm,
conferences and peer groups and things like that.
hmm,
And then by this was the mid to late 90s, and
mhm.
tech was getting more interesting, and the internet had started to explode, and I
Yeah,
wanted
people
to
don't
get
really
in.
understand, selling tech into China in the '90s was like the frontier. It was,
It
yeah,
was
it
the
wasn't yeah,
frontier.
yeah,
We,
it was they were not using it the same
yeah,
right away. It was a very different place.
yeah, and we weren't. The Economist. So I was at the Economist, which is an old,
Pub.
long-standing
Yeah.
brand, but the Economist did a lot of innovative stuff with CD-ROM, and there was a whole electronic world that the Economist was breaking into. Um,
Hmm.
And then I left The Economist in late 98 and wanted to get into the tech world and became the first sales guy at Sina.com, which has gone on to be Weibo, which is now the Chinese Twitter. I leveraged my Chinese
Wow.
experience. I thought I want to get into tech. The only thing I really have to offer is a knowledge about the China market. And so I leveraged that to get into the tech world. And I started to learn about selling,
Yeah.
advertising, and understanding the internet.
You
And
got in the game, which was,
I got in the
people
game.
all smart people were saying, "This is where the new world is happening."
Yeah.
Was there a Chinese dimension to the issue
No,
customer
I
base?
mean, but
Yeah.
my China, I parlayed China into technology, and then I stayed at Cena about 6 months. They had multiple
Yeah.
CEO changes in a very short period of time. And then I went to a company called Virage, which provided software for publishing and managing video content
Oh,
in the early
yeah.
days of video. I got there in '99, and we were really the first SaaS platform for video distribution, and
Wow.
took the company public in 2000. I was part of the management team for that, and then went on. I ran the business side of things at Flickr and
Oh,
multimedia
fun.
search at Yahoo.
Yahoo. Yeah.
I ran
Yeah.
sales and biz dev for a website called Gaia Online, which was avatar
Mm,
based social gaming and
yeah.
virtual world kind of stuff in the first instantiation of the virtual worlds. So my China days are long
Yeah, yeah.
are behind me.
Yeah.
And for Issue, we didn't do business in China at all. Most of our
Yeah.
business was really US, Europe, Latin America, some other in Australia, and certainly other parts of Asia, but that was all pretty small.
So there was a few founders, maybe 4 founders,
Yeah.
Danish pals who got this thing started,
Yep.
and something took off right away and had a huge crowd using it, like maybe the free version and there was a paid version. They wouldn't call it PLG at the time, but there was probably free and trial and
Yep.
freemium and
Yep.
that
Yep.
kind of thing, and I don't know, how did the, dots connect? You're kind of this publishing tech leader, and
Yeah.
this Danish company had some cool stuff. Were they looking for a CEO, or did you
Yeah,
find
yeah.
them? How did
No, they found me.
Yeah.
I hadn't heard of them before, and a recruiter reached out to me and said,
Wow.
"There's this super interesting company that aligns really nicely with your background and all the different things you've done." I mean, when you combine Flickr and Virage and The Economist, and
Yeah.
I've sort of spent my life in this intersection of content publishing, technology, and innovation, uh, and so they were looking for a Silicon Valley based CEO to really help grow and drive the company forward. And
Was that because of something like the founders were technical and they weren't the CEO type, or they were European and they wanted to US, blow this thing up US style, like San Francisco style. Like there was a few Danish founders we've had on the podcast that came to San Francisco and did it the San Francisco way or the Silicon
Yeah.
Valley way.
I think it was a few different things. I mean, I think the first is, I joined in 2013, and back then and even now, the way to grow a software and SaaS company, partnerships are a big part of it.
Okay,
And
right.
ways that you integrate with there is no user who just uses one piece of software.
Yeah.
And we love to pretend that
Yeah, right.
my
We're on the
software is,
islands. Yeah.
but it's not true. And in fact, at Issuu, when our product managers were talking to our customers, you do a lot of customer research, and I was constantly telling them, I want you to spend time understanding what other tools they use with Issuu. Like, yes, understand how they use Issuu and the value we deliver, but the real value that we deliver is the ways in which the efficiency we're able to deliver to them around the ways in which they use other tools as well. So in the case of Issuu, and every software has their own list, but in the case of Issuu, our customers, they used Adobe or Canva or Microsoft. They used us. They had a website that they were using. They often use something like HubSpot. They might use, a distribution or a calendaring system, etc. There's like a whole set of tools that they're using. They might distribute that content. They're distributing their content to Facebook, LinkedIn, Pinterest, etc. And so for a company like Issuu, it's more than just the technology of the product we're making available. It's the ecosystem in which we're playing. And so I think the thinking was, we need to, in order for Issuu to get much larger and to be able to serve the size of the market that's available to us, building those relationships matters a lot. So I think that was one.
Okay, that's right.
Secondly, I think the idea from the was like, there's value. The bulk of the Issuu market was in the U.S., right? The biggest customer base was here. The biggest growth market was here. Western Europe was a big piece of Issuu, but the U.S. was the biggest. And so orienting our focus to the U.S. market made a lot of sense. So I think those were, two of the key things. And I think generally just wanted somebody who had done this before and scaled and grown a company and knew this.
Did they kind of run out of steam? I mean, no discredit
No.
to them. Like, okay.
When I came on board, there were still a couple of founders with the company. The others were no longer here, but I think they took Issuu to a really nice place and brought me on to help grow and build it.
This week's podcast is sponsored by my friends at Cypress Growth Capital. My favorite milestone for practical SaaS founders is after you've survived the first few crazy years and you have some repeatable sales and a growing team and perhaps a little profit showing up. You could grow faster with a little outside capital, but the thought of raising money from VCs would change your whole game. And we know VC funding is the most expensive growth capital on the planet. That's why so many practical SaaS founders I know have partnered with Cypress Growth Capital when they hit that predictable growth inflection point. For 15 years, Cypress has provided non-dilutive growth funding to bootstrapped SaaS founders, including many of the successful founders I've had on this podcast. They love practical founders. Cypress provides enough patient capital for you to invest in your growth without giving up any of your precious equity or having to guarantee a loan personally. Their investment team has people like you who have grown and sold successful software and technology companies, and their operational and entrepreneurial experience helps them give you strategic guidance at those key inflection points in your business. So go to cypressgrowthcapital.com/practical and learn more, and contact Cliff Santel at Cypress to see if there's a fit. Now back to our podcast. Well, you're the first CEO for hire. We have a lot of founders who turned into CEOs, and so that's really interesting. And you're talking about it like it's your baby. It was not like this temporary thing.
I think of myself, I was not, there are too many CEOs out there who come in as CEO for hire who claim that they are a founder. There's a car guy in particular.
Yes, right. A big one. Yes. I drive the car.
Yeah. So I'm not the founder of Issuu, and there's a lot of work that went into getting the business off the ground and the product off the ground that I have a great deal of appreciation
Yeah,
to
yeah.
the founders for doing that.
How
However,
big was the company? Was it like a couple million in revenue and
yeah, yeah. I mean, I feel like I feel like a founder because I felt real ownership for this business and the product. I was not one of these people who was brought in for 2 or 3 years, go figure it out and get it, sell it. I came in
yeah, one and a
uh,
half years
to
is a
take
long
real ownership
yeah,
and felt that, and I kind of nurtured it and grew it and went
yeah.
through lots of ups and lots of downs and lots of challenges and spent a lot of time with the human beings in the business to create a great product and a great business.
What did they have already that you said, "This is real"? Was it, a huge free user base and, companies starting to pay for it with the signs of those green
They
shoots, or
they
was
had a
it
really good
yeah,
user base, a global user base. This was not a Danish oriented go to
yeah,
market, right? It was based in Denmark,
yeah,
but had a huge following. There were really interesting businesses using Issuu, and I was excited about that. Like there were a number of
yeah,
really interesting use cases, and there was nice traffic,
yeah.
and Issuu had started off. There was this very interesting. We were in the early stages of it, but this dual-sided marketplace of
Oh,
providing tools and services to the creators, and then the ability for any consumer to consume that content.
so,
And
the content was in a marketplace to people to
yeah,
find, and you were
yeah,
broadcasting that and waving your hands saying, "Here's a bunch of cool stuff."
yeah. And
Right.
we had an interesting challenge in our business. We had lots of challenges, but one of the interesting things was our business, we sold tools to creators. One of the things that we also made available to those creators was an audience of 100 million uniques a month who consume that content.
Ah,
And so the challenge for us is what's the focus around how we
mhm.
make our business and tools available? Do we focus really on the consumer side of things and become more of a YouTube,
A media
or
company,
are
yeah,
we more of a Vimeo, to use some examples here, where we're providing the tools to the creators, and because the creators upload their great content, consumers want to engage with it. And we experimented in emphasizing different aspects of that, particularly in my first few years, and really honed in on we're doing everything through the lens of the creator. Our business is
yeah,
about catering and serving them. One of the things that we make available is access to an audience.
yeah,
But the core foundation is upload, hosting, transformation, turning their content into the right kinds of information, the data and analytics that were available,
yeah.
efficiency, integrations with the other tools that they naturally are using in their workflow.
Well, I love those ideas. It wasn't maybe these creators didn't know that there was this simple content publishing, expansion tool available, but you said, "Hey, you use Adobe Photoshop and other tools to create brochures and PDFs. It doesn't go on
Yep.
your website. We have this way to publish it." And
Yep.
it probably was a quick description, a quick sale, and the product had to work. So the product
Yep.
had to be great enough. And these creators have very high standards for great products. And
It's
when you
amazing.
started this, Canva wasn't really a thing yet. So it was
Right.
really the
Canva didn't
Adobe world.
exist. Yeah, I mean
Yeah.
Canva existed, but it wasn't well known.
Yeah.
It was
Hmm.
only kind of 6 or 7 years ago where we started to see a real
Yes.
spike in terms of folks
So this was
using
the whole Adobe
Canva.
world, right?
Yeah, primarily
So
Adobe, Microsoft,
yeah.
and various other tools. I mean, there's a lot of tools that creators use that they've gotten used to or that they know well, and so
Yeah.
we were not just an Adobe shop. One of the things that made us some of the technology that was challenging is we had to be able to cater to a range of different formats.
Right. Well, that's an expansive you think about it's a simple core technology, you might say, but, like, there's this ring around the whole product,
Yeah.
the integrations and publishing and every use case and
Yep.
all the ways it goes out. You were the way any way you wanna do it, we can do it.
Correct.
And, did that take, some investor funding to get that
Yeah.
going, or was this a
Yeah. Yeah.
bootstrapped kind of thing? Or it's not a small kind of thing, that you can build with 3 guys in,
Yeah,
6 months?
no, Issue raised money primarily from a firm called Hardcore Capital. They're a Danish venture capital firm. And then we also raised money. When I came on board, we raised some additional funding from KDDI, the big Japanese telco.
Hmm.
But that was in, the last time we raised venture capital money was in 2014. And, I think some of the practicalness of us
Yeah.
is we flipped it to be a US company. I'm a seasoned Silicon Valley executive, but we didn't go raise huge amounts of money from traditional Sand
Traditional
Hill
VCs.
Road
Yeah. Hmm.
venture. We kept Hardcore as our primary investor and didn't raise more. And that came with it gave us a good opportunity, and it obviously came with some challenges, right? I mean, we running Issuu profitably from 2016 to 2020 was a real choice. We looked at, do we want to go
Including
raise?
the investors. They weren't, grow or die, bet it all or die kind of
They
thing.
weren't bet it all or die, but they were investors who
Yeah.
wanted a return, right?
Yeah.
And so we looked very hard at that, that time frame when we started to get profitable. Do we want to go raise a bunch of money? When you're profitable, particularly back then, there weren't a lot of profitable companies.
Right.
And if you're profitable and growing, you become really attractive. And so we had opportunity to go raise more money, but also in raising more money, it starts to really limit choices, right? So
Yeah, let's talk
if,
about that. Like,
yeah,
because if you have a successful company, you
yeah,
can raise money, and if you don't, you're literally saying no for a very deliberate reason.
yeah, yeah.
And why would you say no, knowing that could be quote easy to raise funding and a good valuation?
Yeah. So I think there were a few elements to it. The first is, if you're already growing, if you're going to raise money, you want to do it in a way that you're not just taking the money in, but you have a really clear plan around what you're going to do with that cash. And it's going to be designed to keep building and growing the
Yeah.
business.
Hmm.
And I think for us, we felt like, one, we've got a pretty good handle on, now that we're profitable, we've got a pretty good handle of how to grow and build this functionality. It would have been nice to have some additional cash to do more innovation and to push things faster, for sure.
I'm sure you had a wish list in every direction.
Always
Like,
at a wish
yeah,
list.
right.
You always can use more money. But I think when you're running a tech business, you can always use more of everything. You can always use more people. You can use more money. You can use more partners. You can use more and better technology. Like, there's always
Mm.
more. The second is, if we raised money, it would have dramatically raised the expectations of what a successful outcome could and should
There you
be.
go.
So if
And
we
your other
raise,
investors understood that. Like, we don't want to. If we raise 30 million now, then we got to sell this for 500 million, and you know, who
well,
knows how
once,
long it'll take
if
us.
we
Yeah.
had raised 30 million, let's just say we'd raised $30 million back in
Yeah. Yeah.
2016, 17, 18, something like that. It would have set the valuation,
That's
in
fine.
the 150 to 200 million
150.
dollar
Okay. There you go.
range,
Yeah. Great.
right?
Yeah. Good.
And then all of a sudden you have to have an exit that's, 3x that, just to make people satisfied. That's sort of a base level
Just to
outcome
cover
when
the
you invest.
preferences and get paid as a.
Well, not just like preferences, but once you start to bring money in like that, then you're working with PEs or VCs that have, a particular expectation. There's nothing wrong with them. It's just they have LPs that
Yeah. That's the
they
math.
have a fund to return, right? They're investing in you because you are someone who can help them return their fund. And I
Yeah.
think a lot of people miss that. Like, there's a lot of complaining about PEs or VCs, or like, that's what they do. They are investing money
Yeah.
so
Very
that they
simple.
can have a good return for their own
Well,
investors.
let's be clear. Like, return the fund is different than a 3x pretty good
Right.
result. A
Right.
return the fund is the 10x, the
Right.
100x.
So that's what I'm
It's the
saying. Like,
star. Yeah. Right.
you've got to get to at least 3x just to be, pretty good, right?
Positive. Yeah. Mhm.
And often, if you raise that kind of money, you're going to spend it in ways that start to create a structure where you need to go raise more money. And we didn't feel like we wanted to get onto that hamster wheel of accelerated expectation
Yeah.
with accelerated requirements to keep raising additional funds. Now, that comes with downside. The
Yeah.
upside is it gives us constant optionality, right? We can control our own destiny.
Grow or sell or change profits or,
Yeah.
all of that.
And
Yeah.
so we were in I look around at a lot of companies right now, There's some companies who raised a lot of money in the last 5 years who absolutely should have, and they're going to do really well, and they're going to be unicorns that are successful. There's a lot of unicorns in the last 5 years that are now nothing-acorns, right?
Nonicorns. Yeah.
Non-acorns. I think we just coined a term. So I think it's important to sort of have context. So there's nothing wrong with raising money if you're in a space where you have a really clear path and ways to really accelerate dramatically.
So did you see this business with a very large potential customer base, millions
Mhm,
of potential creatives that
mhm,
publish this kind of thing and a large market, but it was a product-led growth kind of company. It wasn't like enterprise first, just
correct.
add salespeople. Did you look at your business model in the market and say, we're kind of growing within our law of gravity range, right? And we have to make the product better, but we can't go much faster. We can't force the issue. Was it kind of looking at the levers of your business model and saying,
Uh,
if
no, I
if I
think
had
I
30 million, I don't know that I could pay it back.
no, I think if we had 30 million, and I had confidence we could pay it back. I mean, if we had
Okay,
30 million,
okay. All right.
there are tens of millions of people out there who can and should be using Issue.
Yeah.
So it
Okay.
wasn't a
So it's more of
matter
a
of,
choice and less about the simple math, right?
yeah, and I think there's a lot of companies, even practical ones, where yeah, you could go take 10, 15, 30 million dollars. And by the way, in 2021, we took debt. So we did take 20
Ah,
million of debt financing, right? So it's not like we never took money, but we had a philosophy around wanting to have options that once you start raising money, you
yeah.
start to cross off options.
There you go.
And I felt like we were in a business and we were in an environment where having those options available to us was a positive for the overall business and how we grew.
Yeah, and you were holding the line and aligning the investors and the team
Yeah,
around, our approach. I know your next door neighbor, is raising funding and everybody says we should. This is our approach. You
yeah,
held the line.
yeah.
And you raised debt,
And
which is, non-dilutive,
yeah,
but there's other costs and side effects of that drug, to
yes.
be managed as well. Let's talk about debt. You
Yeah.
didn't raise what we see as simple SaaS debt, 1,000,000 or 2,000,000, based on your ARR and
So
kind of
we raised
financing.
in
You raised a big debt.
2021, yeah,
Yeah.
2021, we raised $21 million of debt financing.
Wow.
And, so on one hand, I'm saying we didn't take the 30 million from VC, but we took $20 million of debt and we used that to do a number of things that positioned us really strongly and in fact helped facilitate our exit. So
Yeah, there you go.
we we used it to do quite a bit of testing on the marketing side. Where are new markets that we weren't organically engaging with or accessing? And
Like
we
dozens of tests? Is it this market? Is it this
yeah,
integration?
yeah.
Is
So
it
a
this
lot of that stuff.
model? Yeah,
Yep,
right, yeah.
yep. Different countries, different price points,
Yeah, yeah.
different
Okay,
elements, different. We
okay.
rewrote. We put a lot of energy into rewriting the back end infrastructure. This was a company that had been around for a while, and so
Yeah.
we had
10 years in, you
challenges.
gotta rewrite it in the back end, yeah.
Yeah, and there were things where we wanted to do new price tests, and because of the way things were written in 2014, it was challenging to do that in
I know.
2022, right?
Yeah.
So we rewrote the back end payment infrastructure. We used it to fuel building an integrations team that we finally put in place. So we built out
Mhm,
integrations with Canva, with Adobe, with HubSpot. I've
mhm.
talked about some of those, and those are complicated builds, and so we needed a specialty team there. Then the other thing we started to do is we began to understand that this market and the opportunity that we had transcended product led growth, and there were really interesting enterprise opportunities there. So we built out an enterprise model of the product.
And
And
that's the product floating into an organization, and you follow it and sell the organization that
yeah,
yeah.
we primarily had one price point, and Bob's coffee shop down the street was paying the same as some big
Oh, sorry to hear
Fortune
that, yes.
500.
Right.
And one, we realized that those Fortune 500 companies or Fortune 2000 companies had requirements that we had not been set up to address.
Mhm.
Things like VPAT and single sign on and all of those things that are important for an enterprise. And the truth is, an enterprise doesn't care if it's a product-led growth product. They still want single sign-on. And we're like, well, we don't have single sign-on. So
Yeah.
we built that out and realized we were in a position to charge more because it was a
Yeah, of
more
course.
robust kind of product itself. So we used that $20 million really effectively to grow and build the business and make changes we needed as a and so that was important to bring on, but we did it in a way that was non-dilutive.
Right. So, and you stayed in that zone that you could sell it for, let's say, low nine figures, 100 to 200 million, and and everybody would still win as opposed
Yep,
to have to head towards a billion.
yep. By the
So
way,
you've talked
if
about
we
this.
had raised, if we had
Yeah,
done VC funding, we likely wouldn't have sold because of the expectations.
because you didn't get over that next phase.
Yeah, we did not
Yeah.
sell for $600 million, but we had a
Oh,
great exit, and because of the way because of the way things were structured, everybody got a nice return,
yeah.
and it was a very good positive exit for the business, the
Yes.
company, and everybody involved.
Well, you have talked on a few podcasts and you've written about this on LinkedIn,
Yeah,
the debt game.
yeah,
So the first rule of the VC game is know what you're getting into, and there's
yep,
different flavors of that. And you managed to stay in the practical zone of the venture side of it, or at least
yeah,
investors,
yeah,
equity investors. What can you say to practical founders about the debt game
yeah,
when they're raising a substantial amount of debt, and in some sense, in lieu of a big equity round?
yeah. We had positives and negatives associated with our
I'm sure.
experience with debt. The first is we actually had to refinance our initial lender out of the deal, and we ended up refinancing with a new firm called Eastward Capital, who were a fantastic firm to work with. So the first thing I will
Okay.
say is if you are going to raise debt and you're in the tech world, folks at Eastward Capital are really strong partners to work with.
You're also saying you had a challenge with your previous partner that wasn't a good fit.
Indeed.
Yes.
So, we had challenges with the first partner. Partly, it started off going well. They tried to squeeze us in ways that were really challenging for the business,
Right.
and I was very happy to move on and to find a partner that was a very legitimate lender, and they charged us interest and they made their money, but they were extremely cooperative and worked well with us, even when there were challenges on the table. And I'll talk more about those as well.
Was
So,
was your thinking of raising that kind of debt,
mhm,
and because kind of keeping your optionality, and then you had somebody kind of infringing on it, you quickly
mhm,
changed them out. But was your thinking, we'll go unprofitable, we'll start burning here to make
yep,
these really prudent investments. We
yep,
have really high likelihood of creating the growth we want.
yep.
And then we'll drift back to profitability and start paying it back. Is that how you were thinking about it, or was this
Yeah, I would
a
certainly
little
wasn't.
rocket ride on the way to selling
Yeah,
the company and clearing out the debt?
yeah. It wouldn't be drifting back to profitability, but very much calculating we're getting back to profitability. So the what we did is we decided we're going to take debt financing. It's non-dilutive. It comes with a cost, which is making sure you can hit your covenants. Let's talk about that in a moment,
Yeah,
as well as paying interest. And but what it also does is it's not an additional board member. It's
right.
relatively uninvasive if managed well. And we took it so that we could do the things we needed, both for the growth and to navigate towards a successful exit. And we did that, and we got the company very consciously back to profitability. And the way most tech debt works, at least, you have some period of time where it's interest only. And
Mhm,
so you're only paying back a small amount. And then sometime between 12 and 24 months, typically, you have to start paying back the principal.
mhm.
And we had set the business up so that as we got back to profitability, we would be in a position to pay the
Yeah.
ongoing
Mhm.
uh, payments that were required.
Yeah.
So when you do take debt, there's a couple of biggies to look at. The first is understand the covenants, and I find when I'm coaching CEOs, this comes up a lot around people talk about debt. They see an offer from a debt lender, and there's two, three, sometimes four covenants. And covenants mean, you have to have a certain amount of cash in the bank, or you have to hit
Requirements. Yes.
hit
Yeah.
certain revenue metrics or certain partnership, whatever. There's different covenants get set up. And if you're running a company, generally your mindset when you have those kinds of parameters, you assume that there's some level of flexibility. If you have a specific revenue number to hit with your board, let's say it's $20 million, and you hit 19, but in hitting 19, you established 2 new products and you set up 3 partnerships and you hired your new
Yeah.
VP of marketing or
Everybody would
whatever,
clap in the VC world, right? Yeah.
you know,
Equity world.
then people feel like you're successful and it's going well. In the debt world, if you miss the covenant, part of missing the covenant is part of the business model for the lender. Lenders expect you're going to miss covenants in many instances. CEOs don't quite realize that the flexibility that they have in all other aspects of their business does not apply in the case of covenants and loans. So don't go into a loan if you say, I had someone tell me there's 3 covenants. We feel really good about hitting 2 of them, and I think we'll do pretty well on the third. I'm like, don't do the loan.
There's no leeway at all,
No
really.
leeway.
Yeah.
Right. Now, there are some lenders who, if leeway is needed, will work with you. Typically that happens in the case of banks like SVB when they were
Yes.
doing loans. If you missed, but they understood the rest of your business, if you missed by what's called a foot fault, a tiny bit,
Yeah.
they were okay. If you missed by a lot, they start to collect. The
They call the
alternative
loan. Like
lenders,
they literally say, sorry, not going to
Yeah.
work out. Yeah.
alternative lenders will be much more rigid around the covenants. And it's not like they'll call the loan or sweep your accounts, for starters, but you will have to start to pay higher interest or penalties. And those can be,
And they kind of move in with you and watch everything you do, right?
they can. I mean, it sort of starts slowly and then it
Yeah.
can, So what you want to do when you go into these situations is you want to call, you want to get a list of who did these lenders lend to in the last 5 years. Find out, get a list from the lenders who they are open for you to talk to. Make sure you understand who are 2 or 3 others that they lent to that were not on their list, and talk to people. Find out what happens when things go south. Because in every relationship, when it comes to an investment, in almost every case, something goes wrong, right? If you take VC money, you go in with a plan and you tell the VC, here's what I'm going to deliver. And almost always something comes in
First
to
meeting.
impact that.
The oh
Right.
shit meeting, the first meeting,
Yeah.
the old one. Yeah.
And again, it doesn't mean anyone's getting fired or something terrible has happened. It's part of, we all know when you run a business, it's not a straight line. Things happen. And
Yeah.
so it's who are you working with when those things happen? It's the same thing with VCs. There are some VCs who are fantastic in challenging situations and help you navigate through it. There are some who are more difficult to work with. And often those people who are difficult to work with have something else happening in their environment that's driving that difficulty, right? I think most VCs don't go into a situation like, I'm going to be difficult with this CEO. They go in expecting things are going to go really well, but something might be happening in their firm. Something might be happening with one of their other companies. Something might be happening with one of their LPs. There's a range of things that come up. It's the same with lending. So when you're with a lender, you want to understand, how do they behave historically when something goes wrong? And, what we found with our second lender in Eastward is they were really, it was a really good relationship. I kept making sure we were keeping them appraised of what was happening, where we were going. As we got an offer for an acquisition, we walked through with them what that would look like. They were flexible where needed. They were supportive. Like it worked out really well. They made nice money in this whole process.
Did you still have debt on the books when you
We did,
sold
yep,
the bending
yep.
spoons? And what briefly is what happens when you have debt on the books? Does there a little prepay premium? The debt financer makes some extra money when you sell it, and Bending Spoons either pays that out, or gets their own debt. And is it a reset that happens?
It depends on the structure, and it depends on the buyer. So there'll be some situations where the buyer just takes on the debt. Usually when someone acquires you,
Yeah.
the price they're paying includes you having to pay back the debt.
Kind of
Right?
nets out. So
Yeah.
and it's when somebody says we sold our company for 500 million or whatever it is, and we had some debt, is that usually the after debt number or is that the including the debt number? I
Oh,
don't
I
know.
think most people, when they tell you how much they sold the company for, tell you the absolute maximum,
Yeah, the maximum. Okay, so it
including
includes the debt.
debt,
Yeah, that's
including
right.
earnouts, including,
Yeah.
all the different elements. It's an acquisition number is an interesting thing, right?
Yes.
People
The
will say
story of the
lots of,
number. Right. Yeah.
yeah, people will say, I sold my company for $500 million. Well, you know, 60% of that was stock. How's the stock doing? Sometimes it does amazingly well, sometimes
Mhm.
not so well. So actually you didn't sell it for 500 million. Or,
Yeah.
but by the way, the in terms of paying back the debt, there's no difference than having VC money, because when you raise from a VC, you have to pay that back first before you actually distribute the proceeds
Yeah.
of the deal. So,
Okay.
but in terms of how it actually works, sometimes there's an early penalty. It depends on how long you've had the debt. So if you've, often there'll be a penalty if you terminate the loan within the first 12 months.
Right.
Either refinance it or resell
Yeah.
it, or,
Yeah.
or sell the company. Sometimes it's longer. And in terms of the mechanics of it, typically, again, it depends, but typically the buyer will send the cash to the lender, and then they send the rest of the cash to the account for the company.
Yeah. Did you use a broker to finance your debt, there to find all the right partners and help you go through all of that complicated motion, or did you do that on your own?
Ultimately, we didn't, but there
Yeah.
are a few just fantastic
Yes.
brokers out
Right.
there.
Okay.
Armentum, Fifth Line. There's a few others, and
Spinta Capital does a version of that, and
who
for
does?
the small Spinta
Yeah,
in San
Spinta, also
Francisco.
very
Yes.
good. Yeah,
Yeah.
yeah. And
Yeah.
the cool thing about these brokers is they know the market really well,
Oh, yeah, and all
and
of the complicated debt world. It's really much more complicated with all the
yeah,
terms and
there's something in the
everything.
neighborhood of 400 alternative lenders
Yeah.
each, but then they're grouped into different pieces, right? So
Yeah.
there are some who only focus on enterprise. There's some who only focus on SMB. There's some who only
Yeah.
focus on, we'll do 5 million. They have a limit of how much they can lend. So
Yeah.
there's some who say we'll lend as long as there's a bank involved. There's banks who are involved who say we'll lend as long as your previous VC gives you some money. So there's all different structures. And the great thing about a broker, particularly
Yeah.
someone, that we've just mentioned, they know who they all are. They know who the good players and the bad players are. So they know the reputations. They know
Mhm.
the second lender that we worked with has a great reputation.
Yeah.
They also know about the first. So they will help you navigate to the right partner that makes sense for you. They take a little percentage, but they
Yeah.
take a lot of the stress out of it.
And did you use, an M&A investment banker advisor to sell your company,
We
to
did.
shop it?
We
Okay.
worked with a firm called Lightning Partners, and
Okay.
they had worked on other deals in and around our space before. And then we also worked with our lawyers were fantastic as well. Larry Chu at Goodwin Proctor
Oh,
helped
okay.
us
Silicon
navigate that
Valley
process.
style.
So the combination of those two were really helpful in our process.
And just briefly, and then we'll, close up the interview
Yeah,
here,
great.
but briefly, what was that like? Did you shop it to hundreds of financial and strategic type buyers and get offers for 10 and do the dance and select the one that fit the best for you? Was it a normal kind of process like that, that worked out in the end? And oftentimes you don't go with the highest bidder because of all the other things that are
Yeah.
important, but, what can you
So
say about
we
your
had a process. We kicked it off because we had some initial interest, and so once we had initial
I
interest,
see.
we reached out to others, a combination of strategics and PEs.
Yeah.
What's interesting about the process, and I think most people, this either doesn't get discussed enough or people don't think through it that often. Many folks in the tech world think that there are going to, when they're ready to sell the company, think there's going to be this massive bidding war of, a dozen companies all want us. And the truth is, there are likely a dozen, 20, 30 companies that can and should want you. However, there are often circumstances
Yeah.
around the timing
Not
where,
this year, they can't do it, somebody else in their portfolio looks like that, something, yeah.
I'll give you some examples, right? There's companies that should have bought us. There was one we were talking to like two people on the management team thought we can go build that ourselves. We're not interested in Issuu, even though we know it's strategically important. We had PEs who liked us a lot, but they looked at us through the lens of enterprise, and we were SMB.
Yeah.
And we had potential buyers who had recently acquired something else, and they were working on integrating that.
Yeah.
And so
So it
what
narrows down the
happened is,
list. Yeah.
by the end, we had multiple people very seriously in play. It wasn't, we didn't have 15 stumbling all over each other.
Yeah.
But I think we were like many others. By the end, you have multiple players in play for sure, but understand that a large percentage of the people who can, should, and have an inclination to buy you have something else happening, such that at the time that you're ready to sell or that you're ready to move forward with a transaction because you have a really good offer from somebody, a number of the folks that you think are going to come to the table just can't for one reason or another.
Really
And
interesting.
and so yes, we had multiple, and others have multiple, but it's rarely. There's two things that are rarely the case. The first is it's rarely the case that you have a total frenzy the way we like to think about it. The second is when you're moving in, when you're working in this direction, it's very rare that it happens fast. The way it happens, particularly if it's strategics, they have to know you. And so, we
Right.
often say there's this mythology that Instagram was purchased in a weekend by Facebook. It's not true. There was a lot of work that happened prior to that where Instagram built relationships with Facebook, and Instagram had some amazing momentum that Facebook was concerned about. And so you want to make sure that you're putting in the time to build partnerships with the kinds of folks that ultimately can acquire you. So that acquisition thinking happens typically multiple
Years.
years
Yeah.
prior to the actual signing of a deal.
That's right. Well, great. That's what an amazing story. A practical, scaled up success with debt and some practical equity investors in there. Scaling a global sales and marketing tech business, which has its own challenges there, and being very prudent and measured and reasonably practical. Like you build a crazy kind of business.
Yeah,
That's why I say practical founders means reasonably crazy, right?
yeah,
Yeah,
I'll take that. I'm happy to be
yeah,
reasonably crazy.
yeah.
It's a good moniker.
Yeah, thanks. Joe, what advice do you have for the kind of founders you're working with? And maybe they're up and running and headed towards the scale zone, right? Headed towards 30 million and
Yeah.
maybe more Silicon Valley oriented. And it's a different time than 10 years ago. It's
Yeah.
2025. The world's changing. Are you kind of giving them the same kind of advice about practical funding and approaches, staying in a zone and optionality, or what kind of advice do you have most often for the kind
It
of
really
founders you're
depends
working with?
on the people and the
Right,
company
there we
and
go.
what's going on. I think it's very challenging to either read a book or listen to a podcast and say, "Oh, I'm going to do it this way." I
Yeah.
think, the key things that I like to point out with founders to focus on. The first is CEOs are often told that their number one job is to have money in the bank. I actually think the number one job is to focus on how do you reduce distraction for yourself and your team. By the way,
Mm.
running out of money is a distraction.
Yes.
By definition, our jobs as CEOs are distracting. Things are always coming up. We
Mhm.
need to look at, and in fact, sometimes you might even make a list. Here's our goal. We're trying to hit this revenue, this NPS, this whatever it happens to be. Write down the things you're doing. Is that really contributing? And if it's
Mm.
not, don't do it or have someone else do it. Look at, and I'm using the word distraction purposely instead of focus because these things come into our lives. We think they are important, and sometimes they are, sometimes they're not. So the number one thing I think is how do you reduce distraction for yourself and your team so that they can execute to the plan that you have? I think the second is
Mm.
be responsive. What's happening in the market that you can learn from and engage with? Very different than reactive. Reactive is something happens, I'm just going to make a decision. Responsive means you're taking in information both around the product, what's happening in the market, what's happening with your customers, what's happening with your team, what's happening with your product. And I'll tell you right now, as an example, you know, the best AI companies right now are taking a moment to understand what's going on with DeepSeek, and they're going to be responsive to what that means in the market. They're going to start to make adjustments, not to be reactive, but to respond to new information that becomes available. The third piece, and I'll leave it at 3, is work with your team to synthesize. So we have a lot of folks in roles who do their job, and they might do their job well. What you want as a leader is to work with people on your team who are able to fully understand the goals of the company, the market that you're in, that sort of
Yeah, the
responsiveness,
whole thing. Yeah.
and then execute in a way that helps the company really move forward. How do you start to connect dots? And one of the ways to do that, for example, is to sit with your team and start asking them questions. We have these goals for this year. How do this year's goals start to contribute to where we're going as a business? Who are the partners that we need to be working with to expand things? What else are our customers using? How are we able, because people spend a lot of time focusing on the bugs and the challenges and what's not working. You want to be aware of those things and address them. At the same time, you want to make sure that you're with people who are able to both ask and engage in those questions and help move things forward in a way where they're connecting the dots as well. So I think this notion of you want to be limiting distraction for yourself and your team. You want to make sure that you're operating and executing in a responsive fashion as opposed to reactive. And you want to be working with and nurturing that capability of synthesis in and around your team.
Awesome. Well, those are very wise words and some core laws of nature, but you've put an angle on those that I think founders can hear. They're not simple bumper stickers, but they're kind of leaning in the right direction there. So I really appreciate that, Joe. I'm sure you help a lot of CEOs out there. How can people get in touch with you to find out about what you do for CEOs? I didn't know you were coaching founders these days, but
probably the easiest way is to reach out to me over LinkedIn.
Great.
Or email me if you want, but LinkedIn is probably the easiest way. I'm on there frequently and easy to connect with.
Okay. And I'm sure everybody wants you to be their next CEO for the cool thing that just got funded in Silicon Valley. So, and you're off that trail, at least for now.
Well, I get calls and we'll see, but right now I'm really focused on this and enjoying helping founders grow their businesses.
I really appreciate it.
All right.
Thanks for being on the Practical Founders podcast, Joe.
Thanks,
Great
Greg.
stuff.
Appreciate it.
Thanks for watching this week's founder interview on the Practical Founders podcast. Be sure to hit like and then subscribe to my Practical Founders YouTube channel to keep up with my weekly videos for serious software founders who are building valuable companies without big funding. Check out my blog and information about my Practical Founders CEO peer groups at practicalfounders.com. And follow me on LinkedIn to keep the conversation going. See you next week.